Hello, I'm Juliet Sarli. In this week's edition of IG Macro Intelligence, we take a look at what ongoing trade tension between the US and China means for Australian listed stocks. Investors remain alert to ongoing trade negotiations between the US and China. Investor sentiment was dented mid-October when US President Trump threatened 100% tariffs on China in response to its export restrictions. However, risk appetite has rebounded somewhat as the Trump administration showed openness to a China trade deal, while Beijing called for further talks.
We'll have to see how it plays out over the next few days and towards the end of the month when Trump and Xi meet. What I would say, though, is that I don't think it's necessarily all that bad of a thing for markets to be reminded that there is a lot of gears in the sand of global trade. Even if this 100% increase doesn't materialize, we're still looking at a 30% baseline tariff on Chinese imports to the US. So trade is disrupted, and for markets to be aware of that.
The core of the negotiations between Beijing and Washington revolves around export controls. The US is restricting the export of semiconductors and AI chips vital to China's tech industry, while China is limiting the supply of critical minerals and magnets that are essential to American manufacturing and defense sectors. Morgan Stanley analysts view news of further controls as a positive for ASX-listed Iluka. Shares have risen almost 55% year to date, and ASX TradeWatch data show they're in a strong bullish trend confirmed by multiple indicators. Analysts at Morgan Stanley say Iluka's Eneabba rare earths refinery will produce a relatively high mix of heavy rare earths, where China's export controls have been most strict. Morgan Stanley is overweight Iluka with a price target of $8.60, suggesting around 12% further upside. News of the ongoing negotiations, meanwhile, saw shares in Lynas Rare Earths rise to their highest level since 2011. They're up more than 210% year to date and have also been boosted by reports the Australian government is mulling mandating floor prices for critical minerals and funding for rare earths as part of its own proposed deal with the United States. Yet Ord Minnett has a sell recommendation on the stock and a $10 price target, believing it's run too far, too fast. The broker also noting that mania seems to have engulfed rare earths operators, with investors looking for any excuse for a rally. Ord Minnett believes Lynas shares have left fundamental value far behind, and that its recent MOU signed with a US magnet maker offered no real detail about what the deal may entail. The majority of brokers are negative on the stock, while the average target price, as surveyed by Refinitiv, suggests fair value around $14. Meaning Lynas shares could drop more than 30% from where they currently are. But Rick Squire from Acorn Capital suggests perhaps the recent run-up is justified.
China dominates the full production from mining right through to actual magnet making. And so there's no company that's like fully integrated. Lynas is the best example of that. And so what we're thinking about as investors is actually very different to lithium, because it's really not picking the company that has the best asset or the biggest asset. It's the one that can actually respond quickly and the one that can actually get into production and fill this gap quickly. And I think that's where the real opportunity is in the market. And we're seeing just some early signs of the market realizing that and starting to identify which companies actually have projects that can get into production quickly. And again, it doesn't need to be the biggest, it doesn't need to be the best, but who are the fast responders in the market? And so we're really seeing that.
One stock that may again bear the brunt of trade tensions is winemaker Treasury Wine Estates. Treasury shares plunged 15% on Monday to a 10-year low after the company warned that cautious spending by Chinese consumers during the Mid-Autumn Festival had hit its earnings outlook. It marked the stock's steepest fall since the COVID pandemic, when trade tensions between Australia and China hurt investor sentiment, and also marked its lowest close since September 2015. Shares have fallen more than 50% year to date, and technical data show they're in a long-term bearish trend, as confirmed by multiple indicators, specifically longer term, where the 200-day moving average is stalling, showing little demand for the stock.
Treasury does have very good wines and very good brands, so long term it is one that we will look at from a an interest point of view. But I think at this point in time, there's just too many negatives going on for the company to be going into it. So at best, I think we'd have a hold on it. At worst, possibly, and avoid it at current levels.
Investors had hoped the end of China's trade barriers on Australian wine would boost sales, but demand has lagged, partly due to a government ban on alcohol at official banquets. And the uncertain outlook has also caused Treasury Wine to pause a $200 million share buyback. Yet, having fallen so far so fast, the average broker recommendation is a buy, according to Refinitiv, with a $9.56 price target, suggesting shares could be in for a rally of around 60%. And that is your IG Macro Intelligence for this week. We'll see you next week.